talk to me about the importance of that relationship and what you look for in sponsors?
Yeah, sure. And I think that's a great question because it shows the type of lending we do and the type of lending I think most of the institutions that we and our peer group do is what I call borrower-based lending. There is another type of lending out there, which is asset-based lending. I'll touch on that briefly because that's really quick, because that's not what we do, where people just look at the asset. They don't really care who the borrower is. They look at the asset, look at the value of the asset, they look at the basis, and they're like, I'm providing that loan, secured on that asset. If it goes wrong, I take over the asset. It's called loan to own. And if I get paid back, great. If I don't, I own the asset. What we do and what most of our peers in the industry do and most institutions I know do is what I call borrower-based lending, where you're lending to a borrower, the sponsor that you touched on. And the asset is also equally important, but that's just your security. All the asset is you've got a mortgage, you've got a charge on that asset, and that's your security in case things go wrong and the borrower can't pay you back. But you're never actually meant to invoke that security or enforce on it. Your borrower is meant to carry out a business plan and then pay you back, and then you release the asset. So 100% the borrower has, for us, the borrower is key. What's their track record? We don't want to be the first people back in the borrower in a new sector, for example, or in something they've done maybe many times before, but this is way bigger. Maybe they've built loads and loads of BTR assets over the years, but this one is now 200 units bigger than anything they've ever done before. Maybe they've done lots of retail and this is going to be their first life sciences deal. So we want to back people who've got an established track record in what they're coming to us to lend to. And we're happy to take lower returns for that. It's a very different type of lending. So we think lower risk, lower return. I mentioned we've averaged 15 IRR for the last 15 years now, which I think is great. And on a risk-adjusted basis is great. But there are deals out there you could chase that are 20 plus IRR, even in debt. But we don't want to go for those. So first and foremost, who is your sponsor? What's their background? How long have they been doing this? How strong is their track record? How much cash are they putting in the deal? And what, if additional recourse, have you got on from the sponsor as well as on the asset?
And have you ever had to kind of change sponsor or RFP it? Is that kind of one way that you can, rather than enforce or take ownership of the asset, you can kind of bring in another group who can maybe take over or do a better job or have got better expertise to be able to turn around a particular situation?
Yeah. The beauty of lending, and especially under UK law, is a very creditor-friendly jurisdiction. So absolutely we've had to, not as pre-seed, but in the old business urban exposure, we have had some loans where we've had to change the sponsor group, change some directors of the sponsor, or sometimes keep the sponsor in, but change the contractor if the contractor we don't think is performing. Sometimes we had a project once where we were very happy with the contractor, but the sponsor wasn't performing. But then we had to manage the sponsor. We didn't replace them because, I guess they know you can. So we just said, you have to manage the contractor this way. And we're now going to start managing the contractor and build it out through you, effectively. So we did that and ended up being a very successful project. But yeah, we have had some times where we had to replace the sponsor.